Folks, I believe this stock is going to be the next to 10x. If you're somebody that missed Palantir, Nvidia, AMD, or Micron, well, this might just be your next shot. I'm going to present my case for it, and I'll let you be the judge. For starters, it's trading at a price that hasn't caught up to the business, nor factored in any of the other coming catalysts. It's sitting on a massive record-breaking backlog of signed contracts, very beautiful signed contracts, not just regular ones. It operates in an industry where real competition is virtually impossible to build. Impossibly, it just crushed expectations on earnings. And the market hasn't fully woken up to it yet. And there's one specific and very, very powerful catalyst coming over the next few months that I believe will force the entire market to re-rate this name much, much higher. I'll present my case for this company, and I'll let you be the judge. Okay, let's start with the latest on play. So we got to start with Micron Technology MU. So MU has been in one of the most aggressive melt-ups we've ever seen. It's up about 727% year over year. Now back in winter and spring of 2025, we came out very, very hard to buy the dip on MU. And then earlier this year, January 11th, 2026, I posted our price thesis for the stock. And in my bull case, my prediction was that this stock was a great buy because I believe the math suggested it would grow to $545 a share by 2031. Well, now it's in the 800s, and guess what? It's only May 2026. Of course, markets love to dramatically beat down stocks, punishing stocks that don't deserve to be punished. Then they love to overbuy them. But why is MU doing so great? Well, there's a massive shortage of memory chips. Memory chips are essential ingredients in every AI server, smartphone, and PC. Right now, there isn't enough supply to meet demand, and Micron is one of only 3 companies in the world that makes this stuff at scale. DRAM prices soared 57% in April versus average prices in Q1, and ND prices rose 65% to 70% according to Bernstein's numbers. When the product you sell suddenly is able to be sold at much, much higher levels while your costs have stayed the same, well, your profit margins are expanded massively, and we love profit margins. B, AI is gobbling up every chip Micron can even make. The big AI players, Nvidia, AMD, the hyperscalers building data centers need enormous amounts of high-bandwidth memory to pair with their GPUs. Micron's HBM high-bandwidth memory is co-designed for NVIDIA's next-G Rubin architecture. CEO CJ Mhota told CNBC in March that the key customers are only getting 50% to 2/3 of their requirements because of supply issues. That's a seller's dream. Customers literally can't get enough of this. Next, NVIDIA NVTS, one of the most popular stocks. We first called this a stock out back at $6.79 a share last summer, July 2025. It had already run up some 63% year over year on Nvidia backing news. Now, since it was already up, we had a lot of folks commenting, "This is hopelessly overvalued. It's irresponsible to make the video." However, when we talk about stocks, it's not because the stock is up or down. It's because the company itself, we believe, is valued way, way higher than the current stock prices, and thus that means beautiful opportunista. My argument back then was, look, yeah, this jump post-NVIDIA news is nothing compared to what the next few years is going to bring to NVIDIA. And this week, the stock hit well into the 20s. Today, it's at about $21, just under $21. Now, why is NVIDIA running? Well, number one, they just had this massive India partnership. NVIDIA's just teamed up with Science Semiconductors to launch India's first gallium nitride power IC family, giving them a foothold in India's booming EV, renewable energy, and most importantly, power electronics markets and data centers. This deal alone sent the stock up about 24% in a single session just a couple days ago. Now, the AI data center power story number 2, NVIDIA is pivoting from making chips from phone chargers into what we've been covering for over a year now. Gallium nitride GN and silicon carbide SiC chips for AI data centers. Basically the chips that handle the massive power demands of AI servers. That puts them in the same conversation as the AI infrastructure trade everyone wants exposure to right now. 3, massive short squeeze fuel. So NVTS, of course, is a heavily shorted stock, and the rally seems to be in part due to meme stock short covering. When shorts get caught offside on good news, the move accelerates violently. That's exactly what's going on right here. And then 4, they've got a beautiful fortress balance sheet, and they just did a big capital raise, which means they actually have a pretty nice overall picture right now. Despite burning cash, NVIDIA holds roughly $236.9 million in cash and short-term investments with very low debt. And they just completed a $125 million at the market offering, raising about $122 million net right into this rally, basically opportunistically tapping the demand to fund the AI pivot without crushing the stock. Next, Marvell Technology MRVL. So, I want you to look at this. Oof, oof. Is that beautiful? Of course, Marvel has made it to our top stocks to buy now many, many times. And the reason is because their numbers have long justified it. Back on December 7th, I made the case to buy as much as possible because I said that January in 2026 were really going to be the time for MRVL to really, really shine. In fact, they were already reporting 98% year-over-year data center growth, 73% from data centers specifically, and they just launched their AWS partnership. Proximity is key when you're working with a hyperscaler or a mega cap. You're going to see a lot of opportunity in that, and there's just a lot of room to run if you're in the right market condition, which we've long been in. And if you look at the stock year to date, I mean, it's almost at 100%, aka it almost doubled. Now, why is Marvel running so much? Well, number one, NVIDIA basically endorsed them. NVIDIA dropped $2 billion into Marvel and named them a key supplier for the cable connections that link the AI chips together. When the king of AI says we need these guys, well, the market is going to listen, right? And that's an argument we made before many times. Two, Google and Amazon are paying Marvel to build their own AI chips. The hyperscalers don't want to keep writing massive checks to NVIDIA forever. So what they're doing instead is they're designing their own chips, and Marvel is the partner helping them to do it. Google reportedly tapped Marvel to co-build the next TPU, which is very, very key, and a very key investment for Google and many other hyperscalers. Amazon already uses them for Trainium. That's a huge sticky revenue stream right there. And then quite frankly, the earnings this company has been destroying the game quarter after quarter. But when you're looking at this last quarterly report, oof, is it beautiful? NVIDIA validation, hyperscalers everywhere validating this company. Financials are exploding. Very key reasons why the stock has done so well. Now, when I presented on it in December, a lot of people were saying it was too overvalued. Again, the stock is up another 100%. We kind of have this dynamic where when stocks are going down, people are like, it's not cheap enough. When stocks are flat, they're like, the stock's not moving. And when stocks are going up, they're like, it's too expensive. And it's like, well, at what point is the stock a good buy? The answer is actually very clear. It's when the company itself is worth more than the stock is trading at. I don't care if a stock has gone up 1,000%, if the company itself has gone up 10,000%. Well, I'm pretty happy about that stock price. Next, APLD Applied Digital. Now look, APLD is probably one of the most famous stocks of the last couple of years. And that's because back during the period of time where Wall Street wanted us to believe that tariffs were going to cause an apocalypse and it was going to be complete with zombies and all of that and no stock was going to be worth anything, well, we said, no, this is going to be a great dip buying opportunity. And one of the main stocks we came out for was APLD at a price of 453-ish per share. Now that was just about 13 months ago. Do you know where the stock is trading at now? It's trading at just under $45, so there you have a 10x. Now, a lot of people said at the time the stock was too expensive because data centers were a scam. Data centers were all hype. Well, actually, some companies that actually have real data centers and have been investing and have proof of concept, they weren't a scam. And you could see that by the share price. Now, I'm sure it'll go through other cycles where it'll go down and people say the same thing and we'll come out and say, buy the dip. But that's fine. Anyways, why is it up so much? Well, number one, they pivoted very aggressively from crypto mining to AI data centers. Applied Digital used to be a Bitcoin hosting company, but they reinvented themselves as the builder of AI superfactories at exactly the right time, really. These are data centers designed for the most power-dense GPU clusters ever built, and you're seeing this show up in the numbers. And number two, really massive hyperscaler lease deals showing a ton of proof of concept. When you're signing billions upon billions of dollars worth of deals, well, markets are going to take notice of that. Data centers right now are a scarce asset. I know people are upset because they're being built everywhere. And fair enough, I don't want a data center built next to me. However, if you're a company right now, you need to find data center capacity somewhere. And so any company that already has the built-in data center capacity, and this one already had it because they were converting from Bitcoin mining and they had massive infrastructure in that space, well, any company that has that, well, they have a lot of pricing power because guess what? There's just not much supply of compute right now. And that's exactly the case I made and why I thought it was such a good buy at 453. Okay, next we have to talk about DOCN. We've gotten a lot of questions on this, and I have to tell you, this has been an absolute insane runner. So, just for context, DOCN we presented as one of the most important stocks to buy before 2026. And I explained I believed there was going to be a multi-year breakout coming for this breaking levels that we haven't seen in years. And as of today, it's up 227% year to date, with much of the run happening in the last couple of weeks. Now, why is it up so much? Well, the Q1 earnings were an absolute blowout. Revenue grew 22%, which was pretty solid, but they beat across the board and management raised guidance hard, now guiding 2027 revenue to grow 50% plus. Now the kicker, and what people should really be focused on, is that contracted future revenue, RPO, jumped from $14 million a year ago to $243 million, a 1,700% increase. So that means that customers aren't just spending more. No. They're locking in beautiful long-term commitments. And of course, the stock pops 30% plus alone post-earnings. Now, it's rare that I say this, but I have to tell you, I think that DOCN is getting way too overvalued. I think it's factored in way too much too quickly. And even though I love the company and we've been presenting on this stock, well, I have to tell you, I think this one's getting way too out of hand. Momentum tends to breed more momentum, but again, long term, you have to be buying something where the stock itself is actually lower than the company should be trading at. And in this case, I just can't say, in good faith, that's what's happening. Although, their numbers are pretty damn juicy. Okay, now it's time for the main entree, so Redwire RDW. Now, Redwire is a stock that we called out on May 5th as a great buy. It was at just under $9 at the time, $8.69 to be exact. And as of today, it's just at over $11, which is around a 30% plus run and not very long, a little bit over a week and a half. But let me explain why I believe this has 10x potential and why you're going to be hearing more and more about this before the SpaceX IPO hits. Now, to understand what they offer, understand that when a satellite goes up, somebody has to build the solar arrays that actually power it. Somebody has to build the structures that unfold in orbit. Somebody has to build the navigation systems that keep it pointed in the right direction. Somebody has to build the docking mechanism, the antenna, the in-space manufacturing platforms. And a lot of that time that somebody is Redwire, they've put hardware on the International Space Station. Their advanced optical imaging and sun sensor technology was flying on NASA's Artemis II mission, the first crewed mission of the Artemis program. And on top of that, they own one of the most important small drone platforms in the US military called the Stalker. Here's what you have to understand about the Stalker. Our Marines and our Navy are now flying the Stalker on over 250 aircraft, and the Marines just placed the first order for the upgraded advanced navigation version of the platform. Now let's talk about the re-rating potential around the SpaceX IPO. So unless you've been living under a rock like Mr. Patrick Starr, well, you know that this massive SpaceX IPO is coming within the next couple of months, probably sometime at the end of next month, and you know that they're targeting an up to $2 or $2.5 trillion valuation. And this means that a lot of funds are going to be buying into anything SpaceX related or anything space related before that, and that's already been happening to a large degree. Now, the reason why I'm focusing today on Redwire is because really it hasn't had much run up at all on the space hype, and it's really undervalued even for the underlying company itself. And I'll show some actual proof of that later with the actual earnings that they just reported. But you have to understand one big thing. When SpaceX hits the public markets, or even when the anticipation of that event reaches fever pitch, well, something very predictable is going to happen. Every retail and institutional investor on the planet is going to start looking for ways to play the space economy, and they're going to discover something very uncomfortable. There's almost no public pure plays on space infrastructure. You've got Rocket Lab, which is mostly launch. You've got AST Spacemobile, which is satellite to phone. You've got Planet Labs, which is Earth observation. And then you've got Redwire, the only public company that builds the actual components and infrastructure that goes inside spacecraft across the industry, and also happens to be one of the only ones on the list that hasn't run up 500% year over year. And that's why I believe there's such a strong case for an anticipatory re-rate heading into the SpaceX IPO. Next, I want to talk about competition. So one key thing that you have to understand with Redwire is that it's very difficult to compete with them for several reasons. For starters, you need clearances and qualifications that take years to build, if ever you can get them. Redwire holds facility security clearances that are required to even bid on classified DoD work. Those clearances don't just get handed out. They take years of background investigations, facility audits, and a continuous track record of protecting classified material. A new entrant doesn't get clearances by writing a check. Redwire already has them. Anyone showing up tomorrow does not. Second, you need flight heritage. This is the single biggest barrier in space. Before anyone, NASA, DoD, ESA, Lockheed, Northrop, SpaceX will let your hardware fly on their mission, you have to prove the hardware has already worked in space. Redwire's hardware has been flying in space for years. Their solar arrays power satellites already in orbit. Their imaging systems are flying on the Artemis II. Their structures have deployed on the International Space Station. So again, very key barrier to entry here for any competition for Redwire. Third, you need decades of engineering talent that doesn't exist in the open labor market. The number of engineers in the world who can design, build, and qualify space-rated hardware is very, very small, minuscule. Most of them work at the legacy primes like Lockheed, Northrop, and Boeing, at NASA, or at Redwire. Redwire spent years rolling up companies specifically to acquire this talent. They've absorbed Made in Space, Rockor, Adcol, Deep Space Systems, LoadPath, Oakman Aerospace, and Deployable Space Systems. And that's before you get into the recent edge autonomy on the drone side. Each of these acquisitions brought with them irreplaceable engineering teams with decades upon decades of experience. And a new competitor can't just come onto the scene and all of a sudden hire this talent. It takes a long time to build up that talent, even if you want to try poaching them. Fourth, you need qualifications for individual products that cost millions to obtain. Every component that flies into space, as you might imagine, has to go through environmental testing, radiation hardening, qualification, vacuum testing, thermal cycling, vibration testing, and on and on and on. Fifth, the customer base is structurally locked. The Pentagon doesn't shop on price, as we know. They shop on trust, track record, integration. But once a vendor is qualified on a major program, the switching cost to bring in a new supplier is enormous. So, again, that's another moat there. Sixth, even the drone side has structural barriers that most people miss. The Stalker platform is on the blue UAS list. The Defense Innovation Unit's approved list of drones required and cleared for universal use across government agencies vetted for cybersecurity. So anyways, you have quite the moat here. Now we have to talk about the earnings, because what the earnings revealed and why so many people were talking about Redwire after the earnings was specifically because of this backlog line. Redwire's backlog, the dollar value of contracts they've signed but haven't delivered yet, hit a record $498 million. That's a 21% jump from just 3 months ago and the highest in company history. But the number behind the number is even better. Their book-to-bill ratio was 1.92. In plain English, this means that for every dollar of work they delivered last quarter, they signed nearly $2 of new business. Very beautiful, very juicy. And that's not normal. By the way, most defense companies are happy with a book-to-bill above 1.0. Nearly hitting 2.0 means demand is overwhelming supply to a massive degree. Zoom out to the trailing 12 months and the picture gets even cleaner. Book-to-bill went from 0.9 a year ago to 1.54 today. Now, why does this matter for the 10x thesis? Well, revenue is a backward-looking number. Backlog is a forward-looking number. And given the moat that we just talked about, that backlog, in my view, is essentially locked in. Now, the other part that you have to be aware of is the margin story. And oof, is this one juicy McJuicy. So gross margin jumped from 14.7% to, wait for it, drum roll, boom, 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 to 26.6% year over year. A nearly 12 percentage point expansion in gross margin in a single year tells you that the business model overall is fundamentally improving as the underlying demand for the business is going parabolic, as the competition itself is virtually non-existent. You combine 58% revenue growth with a doubling of gross margin, you get the kind of operating leverage that turns a story stock into a very serious, beautiful business. Juicy McJuicy. It's like that orange juice with the extra pulp. You know, I don't really like drinking the pulp, but it's a lot fancier with the pulp. The revenue growth alone could get you at 3, 4, maybe 5x current trading prices over the next few years. But revenue growth with margin expansion, that's where you get into the 10x plus territory. Now let's talk about some of the specific contract wins that really move the needle here. For starters, the $1.8 billion Andromeda IDIQ. This is a long-term advanced spacecraft contract with the Pentagon. The total ceiling is roughly 4 times Redwire's annual revenue. The full ceiling, if it gets utilized over time, transforms the company entirely. And remember the moat. Once you're in a contract of this size, well, the chance you get displaced is near zero. Then you have their first ELSA order. ELSA stands for Extensible Low-Profile Solar Array. This is a new high-performance, low-mass solar array product Redwire developed. The first sale was a $12.8 million contract. First orders of a brand new product are always the most important orders because they validate the product is ready for prime time. And now Redwire has a new product line with proven customer demand and no real competition. And I think more are going to follow. More Stalker drone orders from the Marines and Navy. They received over $20 million in follow-on orders for Stalker drones in Q1, including the first buy of the upgraded advanced navigation configuration. First buys of upgraded configurations are usually the signal that a program is about to scale meaningfully, at least in terms of other companies that we followed in the space. We're at the beginning of a massive drone procurement cycle overall, and I think that Redwire really has its foot in the door, and they're one of the very few Blue UAS approved government contractors. So anyways, bigger picture, I believe that Redwire is a 10x idea, and the reason is not because I think the technology is cool, not because space is hot alone, but because every single thing you'd want to see in a 10x candidate is already showing up. Not only are we in the right market condition heading into the anticipation of the SpaceX IPO, but the company itself has explosive revenue growth and accelerating backlog, a massive backlog already locked in there, expanding margins, a profitable core segment. It's got generational macro tailwinds, and it's got a moat that prevents competition from meaningfully coming in the way for any realistic stretch of time. So anyways, there you have it. That's my case for Redwire RDW.